Udayan Mukherjee also now joins us on the show. Udayan, hi, good afternoon. Happy New Year. The start has been quite volatile. Today was also quite volatile. Before I talk about the market, I just wanted to have a word on Infosys. I don't know if you've had the time to go through the numbers, but we've seen a big outperformance on the stock. Do you think IT stocks, after the kind of underperformance, can make a bit of comeback this year?
Hi Anuj, Happy New Year to you as well. I don't think this is a sectoral play out here any longer, because if you've looked at the last few weeks of IT performance, Infosys has outperformed, and TCS, which has traditionally been the biggest outperformer in the IT pack, has sort of taken a bit of a backseat. So I think what's going on in the IT sector is general underperformance marked by some degree of separation of performances between some of the frontline players. I think investors are also trying to wrap their heads around which of the 2 or 3 stocks they should have in their IT portfolio in the light of its recent underperformance as a sector. I don't think Infosys numbers are too bad today. They're pretty much in line, but I think their guidance is scaled down, particularly if you take into account the fact that they've used the September exchange rate as the reference for giving that guidance, which probably means they have notched their guidance down a little bit for the year. But that said, I mean, that's not such a big deal or make or break deal for the market. The stock has had a good 5% response today, and after a 5% move, I think Infosys is now trading at close to 17 times 2016 earnings, which is a discount to TCS, but not as marked a discount as it was even 2 or 3 months back. And I think the premium which Infosys now enjoys over traditional outperformers over the last couple of years like HCL Tech has also expanded quite substantially to almost 20%. So this is not to suggest that the stock starts correcting immediately, but as you get closer to the 2100 rupee mark, I think Infosys prices in much of the good news, and it will probably need to deliver on its promise over future quarters to expand its valuations very significantly. So maybe a 3-4% left in this performance. I don't see very serious upgrades coming in the earnings expectation for 2016 on the back of today's earnings. So maybe another day of a little bit of an up move, and then the stock probably flattens out and moves in line with the sector.
The other big news, Udayan, today is that, of course, this is source-based information that the government may exempt ONGC and Oil India from subsidy payment for the rest of this financial year. And we've seen the impact on stock prices today. Do you think, that the kind of ad hocism that we had seen over the last few years, that's going to continue with the new regime as well? Or do you think this signals maybe something different coming for oil and gas stocks over the next few years?
Well, I can only hope that that is the case. But, as they say, burnt children fear the fire. We've got used to too many years of seeing the government being so ad hoc with these companies that we would need to probably see some more concrete action and announcements before one believes the news that has come out today. The ONGC stock had actually fallen a great lot till yesterday's up move, and in the last couple of days has recouped about 5% of its losses, but still remains a fairly significant underperformer since the time crude started its decline. So from a valuation perspective, there is a lot to back ONGC, but on this specific news, I wish the government came out and said in clear tones what they intend to do. But this is a good time, by the way, Anuj, to cut out this whole subsidy sharing business, because the entire subsidy bill has come off very significantly with the fall in the price of crude. The government waited for the opportune moment to do away with or to effect diesel deregulation, and if that is what it's doing now with the subsidy bill having come down significantly to do away with the subsidy sharing business for oil upstream companies, I think that would be very good. But let's hear some announcements from the government before we start opening the bubbly.
Okay, a word on the global setup then, because it's been so volatile. The US markets for last 2 days we've seen big rally in Dow Jones. Before that we had a big fall. What's the sense you get when you look at the global screen, when you look at the volatility index? Is the market in for a prolonged period of volatility, or is this just a passing phase and things should stabilize soon?
Well, there's no way to say that, Anuj. Experts who are far more qualified than me in predicting these things are also trying to figure out which way things will move at the end of January with the Greek election. There's no way to predict it. But I would suggest that this is a passing phase. because in a sense global markets have been preparing for this Greek episode for a while now. Sure, the earlier period of the scare passed many quarters back and markets sort of moved on and the scare has come back to the table. I've heard a lot of people liken the Greek episode to the Lehman Brothers collapse. But I think Lehman Brothers took global markets by surprise. There is no surprise in the Greek situation. Financial markets rarely buckle and completely sell off when they're preparing or moving towards an event which has a binary outcome many weeks before the event. So there could be a correction, there could be a knee-jerk reaction, but I would be very surprised if a Lehman-like reaction happened, even if the Greek event were to go in the wrong direction for financial markets. So yes, volatility right now, and I don't think we are through with our correction here as well. I mean, even if you look at today's bounce back, continuing from yesterday's pullback, we've seen the index go up quite a bit, but if you take out those three stocks, Infosys, HUL and ONGC, the broader market still remains very quiet today. The breadth is negative, the mid-cap index is not doing very well. The leader sector in the market, which is the financials, they have not had a very good day, with big names like ICICI and HDFC actually seeing some selling pressure. So I wouldn't call today's relative calm in the market a big step or a big step towards building up of a rally. I think it's a fairly narrow affair today. So one would need to see evidence in the next couple of days to say that the correction or the big fall of a few days back, where the Sensex fell 850 points, that is over and dusted with, and we have resumed the uptrend just immediately.
But then Menka here, I just wanted to put a couple of questions in on the next set of positive triggers. So you expect the budget will have that potential. And you mentioned Hindustan Unilever. It's a stock we've spoken about quite a bit through the course of this week. How do you assess the close to 14% gain that we've seen on that stock in just 4-5 trading sessions?
It's remarkable, Menka, the way HUL has come back. My sense also is that it's not just a HUL-specific trade. I think HUL is benefiting from a lot of money which is coming out because of the recent bout of risk aversion which has suddenly hit the market. Earlier, when there was a period of volatility, or there would be periods of volatility because of global events, you had one or two or three hiding places. IT would be an obvious one, pharmaceuticals would be another, and some of the consumers would be the third leg. Now IT is not so much in favor. I know today Infosys has gone up and picked the rest of the sector with it. But the evidence of the last few weeks and months seems to suggest that global investors are not in a hurry to deploy a lot of money into IT. Pharmaceuticals is too stock specific and a smaller sector. So I think HUL is the beneficiary of a lot of default money which is going in, benefiting from the kind of volatility that's sort of shrouding the market at this point in time. I don't know whether it's a prelude to the HUL numbers in a few weeks' time and whether the market expects good things from there. But you can sense that a lot of the money in the Indian market, which was probably playing for the cyclical theme, which is buy infrastructure-related stocks, safe haven is IT, and buy a lot of financials, I guess is probably rotating around a little bit to say, let's focus on quality and be a bit defensive for the moment till this global scare passes over, because anyway we are wading through an earnings season which is not expected to be great. So both from an earnings perspective and from a global perspective, I think the recent volatility might have sent a few people scurrying for high quality defensives.
Okay, well then the other part, what about a pre-budget rally? Do you think the market will have a pre-budget rally, or is that too simplistic to assume?
Markets usually have pre-budget rallies, and there's a lot of expectation around the budget this time around. It's the first full-fledged budget of this new government. If global markets permit, and that's an important caveat, because 25th January is the Greek election outcome. You have 4 weeks after that. If you have a very bad outcome from the global scene, leading to enormous volatility in global equities, then I think at least for some time, that theme sort of rides over any kind of pre-budget rally that we must strike out here. But if that's an even-Stevens kind of an event and does not lead to too much turmoil in global markets, and it's a big if, then I think in February we will probably have a pre-budget rally, because one thing which would have happened is that the markets would have consolidated quite considerably by then. I'm assuming it will. So you would have seen the market pause at 8,400, go back and test 8,000 a couple of times, sort of to and fro between these levels, and then spend some time within a trading range. And if the global event gets out of the way without injecting too much volatility or uncertainty, then I think it sets the pave for or paves the way for some kind of pre-budget rally, even if it lasts just about 3 weeks going into the February event. There may be many good things which will happen in the budget this time around, in GST included. So I cannot believe that the market will not at least take a gamble on the budget this time around if global events permit.
Okay, final question then, Udayan. For last 3 or 4 days, we have seen big FII selling. Even yesterday, when the market actually went up so much, there was FII selling. Is there a risk that there's a bit of churn going on from India to a couple of other markets, which the market is not realizing now or is not reflecting now, but that could be a bit of pressure point for the market in the medium term?
It's possible. We would like to see some FII money coming in, and I suspect the fact that you've seen some selling in financials today, Anuj, is also reflective of the fact that at higher levels there is still some supply coming in from the foreign funds. One would like to see an end to that. Also, some short positions had been created on the Nifty futures front. Some of them might have got covered in the last couple of days, but I don't think entirely the entire amount of short covering has happened already. It's a little disconcerting to see why FIIs are selling. It could be, I mean, you cannot read into the minds of FII fund managers. It could be, as you suggested, because of some money going into competing markets like China. It could be because of the precipitous fall in the price of crude and sovereign wealth funds therefore becoming a bit cautious and even taking some money off the table from wherever they have profits. It could be a general risk-off which is affecting all emerging market funds and leading to some redemptions there. And I think that may well be part of the reason. But I also think that stung by this global volatility and risk-off, the easy low-hanging fruit to take money off is where people have already made money or quite a bit of money over the last 6 to 9 months, and India is on the top of the chart there. Last year the market went up 30%. A lot of funds would have given returns of 40-50% or even more if you were in mid-caps. And therefore, with such a big risk-off happening globally, with an important event ahead of us, it's very natural that many of the global funds would simply say, let me just take a bit of money or books a bit of profit from where I have profits, and India is a big profitable destination for the last many months. So my sense is the FI selling that you've seen for the last few weeks is part profit-taking and part of the general risk-off redemption pressure that many global emerging market funds would have been facing over the last many weeks. You don't want to read too much into it, but if it persists beyond January and beyond the global event that we are alluding to, then I think there would be some kind of concern in the interim.
All right, Udayan. Thank you very much for joining us this afternoon.